Let's look at doing velocity banking with this budget. She actually has quite a bit of money left over at the end of the month that's going to pay down the credit card debt. She's been able to increase her income to $11,000 for the next 6 months. With this increased income, the credit card balances should be going down around $4,298, or she could put up $1,000 in savings and still have the credit card balances go down $3,298. Now, this is before these student loans kick in. The minimum payments on those are very high, so if this kicks in, this number obviously would be lower. Remember, with velocity banking, we take the income, we subtract any cash expenses, which are these expenses here that I have marked in green. Those are anything that cannot be paid with a credit card. So this would be things like mortgages, personal loans, or car loans. Then we pay everything else to the credit card balances. We wait for the statements to close. They're going to charge interest. Then we go back and put the other spending back onto the credit cards. This is how we get this number. Now let's look at it on the planner. I believe her paydays are on Fridays. She gets $2,600 per week. Let's start with a paycheck on the 3rd. We're going to assume that the rent was paid with the paycheck from the previous month. I know this planner says May, but these dates should be the same as January of 2025 as far as how the days line up. The first thing we need to do is go through and find the cash expenses. So this loan here would be a cash expense, this car payment here, this RV, and this car payment over here, and then the rent as well. So the paycheck on the 3rd, we get $2,600. We go through, we find any cash expenses due between this paycheck and the time that the next one comes. So it would just be this one loan payment here of $741. So we would subtract the $741. This would mean we have $1,859 to pay to the credit cards. Now during this paycheck, we only have one credit card payment that's due, but we can always go forward to the next paycheck to see if we can pay off some of those cards as well. Let's look at the American Express, this Capital One, and Discover to see what we can do with this $1,859. The balance on the American Express is $810, so we can pay that off. The Capital One, the balance is $541, so we can pay that off. So if we take the $1,859 minus the $810 minus the $541, this means we have $508 that we can then pay to that Discover card. So these two cards are paid off completely, and we pay $508 here to this card. So now we got the paycheck, we paid the cash expenses and some of the credit cards with that one check. Now what we do is we wait for the statements to close on the credit cards before putting the other bills back onto them. Because we want these credit card balances to report at lower amounts. That's going to increase the credit score more. Looking at the balances on her credit cards, her credit score probably isn't terrible as it is. But we still want to make sure that these report at a 0 balance and this one reports at a lower balance. That way we're charged less interest. Once you get to the point where you're paying off the balances completely on the cards each month, you shouldn't be charged any interest. So we have a couple bills here that are due before these statements close. Those two bills would more than likely go on this American Express card that closes on the 2nd. So that American Express card would have closed here. You would pay both of those bills with that card. Now we need to look at the bills that we're going to pay with these 3 cards after those statements close. So we have this bill here, this car insurance here. This is a cash expense, so it doesn't count. And then we have food, gas, and miscellaneous spending. I separated this up so it'd be about $287 per week on food and gas, and then $150 per week on miscellaneous spending. So we have $150 plus $130 plus $287 plus $150 that needs to go back on these cards that we already paid. The total for this would be $717 going back on the card. So obviously we paid a lot more to the credit cards than what we're needing to spend back. So that's how the balances on the cards go down. Remember, we paid off this American Express completely. We could go in and put this full $717 back on the American Express card. This would mean this balance is still paid off, and this balance here has still gone down probably around $400 after they take out interest. Now we get the second paycheck on the 10th. So again, we get $2,600. We go through and we find any cash expenses that we have to pay between this check and the next one. So you can see there's no cash expenses that week. So we have the full $2,600 that we can pay to the credit cards. Remember, we already paid these 2 cards early. So what we're gonna do with this paycheck, we'll probably pay the Best Buy, the Care, and the Chase credit card with this $2,600. So with the $2,600, we can pay off the Best Buy card, we can pay off the Care credit card, and then pay anything else left over to this Chase card, which would be about $960 that we could pay. So these balances would be at 0. This one will go down probably around $900 after they take out the interest. Now we're gonna go back and see which bills we're going to have to put back on these cards. If we look through this week, we've already paid some of these bills here, so we can look out to the following week. The next week we have the phone bill, the internet, and then we could also pay the second phone bill here, and then the food and the gas and the miscellaneous. So all of those would total $877. Now in this case, we have a lot of credit card statements that close before these bills are due. So we could use any of these cards here. So I'd probably use the American Express, the Discover, or the Capital One, or a mix of all three to pay this $887. So we could put it all back on the Chase card, which would bring the card balance back up close to where it was at the $32.09. But remember, we still paid off these other two cards here. So when next month comes around, we won't have to make these payments, and we can make this full payment to this card here, as long as we're not spending back on these two cards here. Now again, the paycheck on the 17th, we get another $2,600. We go through and we find any cash expenses, which in this case would just be the car payment of $359. So we subtract the $359, which would leave $2,241 to pay towards credit card debt. We've already paid the American Express, the Capital One, Discover, Best Buy, Care, and the Chase card. So now we look at the Bank of America and the American Express Gold card. Both of these card balances are pretty high, but we have $2,241 that we can pay to them. What I would do is pay $1,000 to this American Express card here, and then I would pay the remaining $1,241 to this card here. And then let's see what we need to put back on these cards. So we've already paid all these other bills for the month that are going back onto the credit card. We do still have to account for food and gas and miscellaneous spending, but that's it. So maybe after the Bank of America card closes, you might put that back onto that card. The totals for the food, gas, and spending would be $437. So the Bank of America, we paid $1,241. We could put this back on that card. We could put $200 of the $400 back on this card and then put the other $237 on this card. Just make sure once you go in and spend that amount that you stop spending. That way you make sure that these balances are actually going down, and they should be going down very quickly. And then remember, in addition to this, okay, we're pretending this is January. So remember, in February, this bill here and this bill here will go on one of these cards here. That would actually be added to this amount as well, because this statement likely closes on the 2nd, so we can pay both of these bills here with that. So in just 1 month, we should have paid off 1, 2, 3, 4 credit cards. And then the balances on the other ones should have gotten quite a bit lower. Now the thing is, the balances are going to fluctuate. Even though we paid off this $810, remember we were going to put $447 back onto that card. So the next time we get paid at the first of the month, instead of paying $810, we only have to pay off the balance that we put on there, which is $447. And then we can use the extra money left over from the paycheck. We're not paying off this card next month because it was already paid off. So we could use it to pay down one of these other cards that have higher balances. Once you get to the point where your statement balance is paid on your credit card, that is when you're no longer charged any interest. For this example, let's pretend that this balance here, the $32.09, we were able to pay $2,000 to that. So if we let it report that way, the balance would be $1,209. This would be the statement balance. So the following month, as long as we paid off $1,209, the month after that, we wouldn't be charged any interest. I know this is confusing, but there are those two different balances for your credit cards, the statement balance and the current balance. If we get to the point where we're paying off the statement balances on the credit cards, we won't be charged any interest, which is another plus of doing velocity banking. We do get to that point faster. Using velocity banking, these credit card balances are going to go down very, very quickly. They should be going down around $4,000 per month. One of the hardest parts about this is planning exactly every single dollar that's going to be spent back on the credit cards and then not spending any more once you've spent that money. Let's use the Bank of America card as an example. So we paid $1,241 to that card. So the balance started at $14,616. We paid $1,241. Now the balance is down to $13,365. Now they are going to charge some interest on this balance. So when this statement closes, they're going to charge interest. So the balance will go from this up, let's say it's $350 for interest. So now the balance is going to report at $13,715, which is almost $1,000 lower than what it was before. Now remember, we had $437 that we were going to put back on one of these cards. Let's say we're just using this card. So after we spend the $437, once the balance gets to $14,152, we don't spend any more on that card. So we made the $1,241 payment, they charged interest, and we put the bills back on the card. The balance is still quite a bit lower than what it started at. And then the next month you go in and do the same thing. And in this scenario, we paid all of these bills with this card here, so this balance will go down minus whatever the interest charge is, this amount. So again, these are just all things to look at when you're doing velocity banking. It is a lot easier if you have an income that is high compared to your expenses, because you're actually able to see those balances going down or being paid off. If you like these videos and you want to see more of them, please subscribe and let me know if you have any questions about velocity banking, credit cards, credit scores, paying off debt, or anything else.